Hi, this is Peter Hans, and welcome to this week's episode of Between Two Chains. This is Monday, August 22nd, but we actually recorded this on Wednesday, the 17th. This is episode 2 of season 2. I was joined by Arca CIO and co-founder Jeff Dorman. We had a really great discussion this week. It was, on the heels of the call with Raoul Paul, talking a lot about the macro environment and how that's indicated a bottom. With Jeff, we talk a lot more about the fundamentals, the growth and subsequent decline, based on a lot of the just dynamics that are present in this nascent ecosystem. We get into a little bit on ETH, and although we both try to avoid it as much as possible, we couldn't help but talk a little bit about Bitcoin at the end. So I hope you enjoy the episode. Please rate and review. Thank you so much. This commentary is not intended to be investment advice, investment research, or recommendation. Please consult your investment professional for your own circumstances. Okay, welcome to episode 2 of season 2 of Between Two Chains. I am Peter Hans, and I am joined by Arca's co-founder and CIO, Jeff Dorman. Those who frequented season 1 had the pleasure of listening to Jeff and I talk on all sorts of different topics. We're recording this on Wednesday, August 17th, and it's been a hell of a year, Jeff.
Yeah, a lot going on. Some good, some bad, but good to have the show back.
Some good, some bad is a good way of putting it. It's much more optimistic than you usually come across, but I'll take
Well,
it.
yeah, I mean, look, as investors, no matter what you touched other than commodities in the first half of the year, you probably got hurt, right? I mean, everything from, debt and equities, the worst, first half ever for a 60/40 portfolio of debt and equities. Obviously real estate starting to come in a little bit, digital assets, down 50 to 80, 90% depending on where you look. It hasn't been kind to investors, but it doesn't mean there hasn't been good things that have come out of the 6 months, right? So, for example, the deleveraging of the system, obviously the deleveraging process as itself on its own, not great for the market, but heading forward and looking forward in a more delevered environment where you're going to have tighter risk controls, that's generally a good thing. Things like, of the 12 or 13 bankruptcies or impairments that we've seen in the market, all of them were centralized companies, right? Meaning they have a real CEO, a real board of directors, and, individuals making decisions. Their counterparts on the decentralized side or DeFi, who had all the same customers and all the same tokens being lent and borrowed, we didn't see any problems at the protocol layer, no hiccups, no defaults. There's things like that you can certainly point to in terms of progress for going forward. It doesn't absolve the problems in the industry or the price action, but that's what I mean by some good, some bad.
Sure. No, but I mean, to be fair, when you talk about, yeah, there's been no bankruptcies on the decentralized side, but there also can't be a bankruptcy, like, because there's no corporate structure to bankrupt, right? But, like, if there could have been, and, it's not like Luna wouldn't have been bankrupt, or probably a number of other, side chains or assets or DeFi protocols that, are not terribly viable. It doesn't mean the system doesn't work. It actually works tremendously well, and the market dynamics are allowed to play out. But you might be comparing apples and oranges there a little bit.
Yeah, I mean, I'm not specifically talking about the bankruptcies from an investor standpoint in Celsius. I'm talking about the impairment of the customers of a Celsius, right? If you're a
Sure.
customer, then take what Celsius did, for example, right? Celsius, at least the way they presented themselves, was basically a bank, right? You can deposit there, you can borrow there, and you can swap assets there, right? There's plenty of decentralized businesses, like from Aave to Maker to Compound, that basically do the exact same thing, right? Independent of the bankruptcy filing itself of Celsius, it's pretty clear that customers of Celsius are going to be impaired, right? We at Arca think recovery is probably in the 30 or 40 cent range at best in terms of customer recoveries right now. That's very different than the customers of Aave or Maker or Compound who have been unaffected by what's going on, right? You could say the protocol itself, maybe they have lower customer usage right now, maybe the revenues are down, but the customers aren't affected. And I think the sad irony about this is that if you actually look at Voyager's website or you look at Celsius's website or any of the other companies and projects that have had problems from your Genesises to your BlockFis to your Babel Finance, et cetera. I think, like I said, all told, I think there was 12 or 13 major impairments or filings. A lot of the tokens that were being used as collateral were, in fact, DeFi tokens, your Aves, your Makers, your Compounds, your Unis and Sushis. And, the irony there is if, these people had taken the time to learn how to use the protocols rather than just buy the tokens and use a centralized counterpart, you probably wouldn't be in this mess. Now, that doesn't absolve all decentralized protocols. Obviously, there's still hacks and risks with bridges and things like that, right? It's not, as you said, it might be apples and oranges. There's certain problems over here on the centralized side, and there's other problems on the decentralized
Mhm.
side. But in general, I think when you're looking at takeaways from the last 6 months, that at least is one of the takeaways, in my opinion, is that decentralized protocols themselves worked as designed.
Yep. No, I mean, I think that that is true. And I mean, we even, not on this podcast, obviously, because based on when, the break between the seasons, but, even as big of a disaster as of, something like Luna and UST was, the actual, withdrawals and unwinding and execution of the mechanism worked as designed. It was just, one could argue the design was flawed in practice, or certainly the execution was flawed, but it worked. So, maybe let's pause there and talk about where we are, and not so much in the cycle, because I think I don't think much has changed in terms of long-term outlook or viability of blockchain as a technology and what it can represent, but kind of in the shorter term, given the massive volatility around the asset class. And I think the optimist in me is hoping that we just kind of see a tale of two different cycles in one year, where the first half of the year was pretty much straight down with ETH off 80% and most assets, some assets down more than that, and so far July, August a little bit better, um, and maybe the fulcrum there is post Luna. But yeah, I would love to just hear your thoughts. Where do you think we are, and what kind of green shoots are you seeing? Where last episode, Raul talked about the bottom's in. Do you agree with that sentiment?
Yeah, I actually do. I think the bottom is in. I think there's a lot of reasons to believe that that's true. I'm not 100% sure we scream higher. You need growth and you need users to come back in volumes and transactions before you meaningfully go higher. I think that's one of the biggest lessons that we all learn in digital assets. Not necessarily this year, but you learn that early on, is that this is still sort of an infrastructure play, in the sense that I'll use an analogy, right? If you go back to the early 2000s, every new internet company was called something.com, right? Priceline.com, Amazon.com, Pets.com, right? Basically, you were announcing that you were an internet company by putting .com in your name. Of course, now, 10, 15, 20 years later, that's ridiculous, right? Everybody's an internet company. You would never, call yourself a .com. It's assumed that you have an internet presence. 20 years ago, the only companies that had a internet presence were internet companies, right? Meaning they would not have existed if not for the internet, right? Amazon would not have existed if not for the internet. Pets.com would not have existed. eBay would not have existed without the internet. Now, everyone from JP Morgan is an internet company. Domino's Pizza is an internet company, right? Your auto companies are internet companies, right? Everybody is an internet company, regardless of whether or not they started because of the internet or existed before the internet. I think the same thing can be true of blockchain companies right now, which is basically anybody who is a blockchain company is effectively a crypto right now. They only exist because of blockchain. In 10 years, that won't be the case, right? Every company will have some form of a blockchain presence, right? They'll either be doing internal things via blockchain, or they'll have their own token. We've talked at length about how, I think Disney will have a token one day, Netflix will have a token,
Sure.
universities will have tokens. So, as a result, the reason I went back to that for a second is, if you look at today's tokens or today's blockchain investments, right, your crypto companies, they're all levered to the exact same inputs. And that is, you need user growth, you need volume growth, and you need transaction growth, right? Because everything right now that exists is based on Is there speculative trading? Is there transactions of stables and ETH and other tokens? Is there volumes, whether it's gaming or DeFi or whatever? It's all a very volume transaction based business right now. So when that goes down, which it has over the last 6 months, every business is affected, whether it's a gaming business, an NFT business, a DeFi business, a Web3 business, you name it. Again, 10 years from now, that probably won't be the case. You'll have much more differentiated business lines that aren't affected just by the transactions and the users themselves. So in order to see real growth, we have to see that return. We have to see those users, those volumes, and those transactions to return. On the flip side, though, I do think the bottom is in, right? I think you know, one of the things that I'm a real big believer in is that we have decoupled completely from macro. And I know it doesn't look like that way if you look at just Bitcoin. In fact, if you track, if you're still one of the, dinosaurs of the industry who still say Bitcoin equals the crypto market and there's nothing else, you would have a reason to say that Bitcoin is still very correlated to equities right now. But if you look beyond that, the correlation broke down 2 months ago. And I think as a result, you can really kind of pinpoint where that bottom is. And it was when we had that deleveraging cycle starting with May 10th to May 13th when Luna and UST imploded. And then, 3 to 4 weeks later, when the aftermath of that caught up to things like Celsius and Voyager and Three Arrows and everything else. So what's interesting though about the recovery though is if you look if you look at sort of the downward trend, call it starting in November of last year, right? That's when the first real signs of inflation getting out of control and the Fed and other central banks having to step up their effort to fight it. There's no question that starting in November of last year, this has been a macro trade, right? Whether it's been digital assets, equities, debt, real estate, you name it, it's all been macro driven. But I would argue in May is when we decoupled. The issue is most people in digital assets, including ourselves, assumed that digital assets would decouple to the upside, meaning that eventually we'd break out of this downward spiral with equities and digital assets would go higher. What actually happened was the opposite, right? Digital assets decoupled, but to the downside. So right around Terra Luna UST in May 10th, that's when digital assets really took a huge leg down, even though equities were, not totally bottomed, but had close to bottomed already. And then again, we took another leg down when you had the deleveraging of all the Three Arrows portfolio, which was around, I'll call it June 10th to June 20th. That's when you saw another huge leg down. Bitcoin fell from 30,000 to 18,000. ETH fell from 2,800 or sorry 1,800 down to 900. That was 100% the unwind of the Three Arrows collateral. So those two idiosyncratic events pushed digital assets away from equities and macro because that was a very digital asset specific event, right? That had nothing to do with the broader market. Terra Luna, Three Arrows, Celsius, Voyager, that was digital asset specific. But then what was interesting is on the other way, right around mid-July, I think it was like July 18th to July 20th, you had two very, right around June 20th, apologies. You had two very idiosyncratic events happening at the exact same time, but had completely different results. So the first was that was the time where the Fed came out and basically said we're going to be more data dependent from now on. We're going to look at the data and make our decisions. So basically, we went from this. Everyone assumed the Fed was just going to be full blown raising rates 75 bips at a clip to fight inflation. To okay, we'd gotten to a steady state or a neutral state, as the Fed said, and that now we're going to be more data dependent. So from a macro standpoint, right there, you had commodities starting to fall off a cliff. You had the manufacturing data starting to fall off a cliff, housing data falling off a cliff. So the market took that as okay, peak inflation has already happened, and now the Fed might take the foot off the gas, right? That's why the 10-year rate went from 3.5 down to 260. That's why equities started to bottom. That's why the macro environment changed from inflation dependent to now recession dependent. At the exact same time, though, was when the Ethereum developer call happened, where for the first time they put an actual hard date on when the Ethereum 2.0 merge was going to happen. And that was the first time that there was a very specific date. There's only about 100. It's interesting. As big of an event as this is in digital assets, there's only about 100 people on that call. But that was the exact same time period. They said this is going through, and we're going to have the Gurley test net and all the other things that have happened in the last month and a half to prepare for this Ethereum 2.0 merge. So even though digital assets started to go higher and equities went higher at the same time, they were for very different reasons, right? Equities went higher because of the Fed pivot narrative, and digital assets started to go higher because Ethereum led the way with this ETH 2.0 merge. And then on top of that, If you look at all the other tokens that went higher, again, Bitcoin has been stuck. Bitcoin's done nothing. It's moved just like equities because Bitcoin has lost its narrative, which we can get back to in a minute. But things like Uniswap moved higher because they started introducing an idea of a fee switch. Lido started moving higher because of this idea of the ETH 2.0 merge and increased staking. You had DYDX moving higher because they announced that they were going to move away from Ethereum and onto its own chain on Cosmos. Long story short is you had all these big idiosyncratic digital asset specific moves that drove markets, but a lot of people from the outside looking in just said, oh, equities and digital assets bottomed at the same time, therefore it's just a macro trade. So that's where I would argue is very different right now. I think digital assets are back in their own world, trading on their own specific news, independent of macro. And we'll see. But I think that's a very positive risk environment for digital assets specifically over the next 6 months.
Okay, there's a lot there. So last episode, Raul was talking about, and obviously, he's a global macro investor, right? So he's clearly very focused on the macro environment, the rate environment. I think most importantly for price action, he's focused on liquidity, right? The market tanked because there was no, I mean, there was obviously an unwinding and there was no liquidity coming from a buyer market. Once that liquidity got washed out, right, then there's, in essence, no marginal sellers left and still, some demand. So, and this coincides with, a potential Fed reversing course and so on and so forth. So, um, you both, I think, arrive at the same conclusion in terms of, upside market bottoming. You're obviously looking at it from a much more fundamental perspective versus a macro perspective. Um, I don't think there's any debating that macro plays a massive role nowadays in every market, right? Because it's cost of capital. But at the same time, the digital assets market currently in its unregulated state and state of call a spade, like very, very small market in terms of participants. Um, it's going to have very substantial moves as those markets shift because of the large potential discrepancy between incremental buyers and sellers. But I think to your point on the fundamentals, one thing we have seen over the past, call it 90 days or so, really post Luna, is a dichotomy of performance in assets, which is normally not something you see in big macro driven environments, even in digital assets, right? It's typically in a market's down, everything's down, maybe Bitcoin and Ether down a little less, when everything's ripping higher, everything's higher, and degen assets are up more than Bitcoin and ETH. So maybe speak to that a little bit and do you think that's an accurate assessment, or are you still saying it's really purely fundamentals?
No, I mean, look, nothing's black and white. I would never say it's purely fundamentals. Macro always matters, but let's not forget, like we're talking as if the last 8 months were the norm, right? Up until November of last year, I don't think there's a single digital asset trader except for the guys like ourselves who come from the TradFi world who even knew that CPI prints came every Monday or every month. I mean, or that jobless claims data came every Thursday. This is, everyone over the last 8 months in the digital asset world has become an armchair macroeconomist. But before that, it didn't matter, right? I mean, there was very few who hung on the words of every FOMC meeting. There was very few who cared about the economic data that was coming out. If you look at correlation, obviously correlation data is very dependent on the time frame that you're using, but digital assets are incredibly uncorrelated over any longer period of more than 18 months. And in fact, that correlation changes all the time, right? I mean, you've gone from correlation to gold, to correlation to equities, to correlation to the dollar, to correlation to rates. I mean, it moves all the time. And by definition, that is what uncorrelated means. Uncorrelated means there's no, a pattern of correlation. So the last 8 months, there's been no doubt that we have been in this macro trade. But that doesn't mean that we will always be in it forever. And the reason I think it's starting to really decouple, in addition to the fundamentals, is also because of the technical flows. We're now looking at a 1.1 trillion, or actually after the last few days of sell-off here, we're looking at basically a $1 trillion asset class, all of the publicly traded digital assets. Of that 1.1 trillion, 450 billion is Bitcoin, which is in its own class, its own world, completely, in my opinion, independent of everything else in digital assets.
Yep.
And then another 175 billion is stablecoins, right? So you're looking at 650 of the 1.1 trillion is basically completely different than the rest of the market. So you're only looking at 400 to 500 billion of other tokens out there. And I would argue that of that, a lot of them are ghost chains and things that most people don't care about, like your Bitcoin cashes and your Litecoins and things like that. So the true investable universe of tokens is down to like 300 billion of assets relative to 175 billion of stable coins, which can only realistically be used to buy those assets. So independent of macro, I mean, you have a very, very, very small investable universe and small window to jump through with a lot of cash and a lot of interested people who are now in this market. So, that doesn't mean that correlation can't stay high, but it means the magnitude and the dispersion that you're talking about will also stay high, right? If three investors decide to go out there and buy Uniswap tokens, it's going to move. It's going to move in a much bigger way than something like a Bitcoin or something else, right? And same thing if there's a seller or two. So I think, I'm not dismissing macro as being relevant. It will always have some level of relevancy. I just think that we have been completely dependent on macro from November to May, and I just don't think that's the case anymore. I think macro is now one of many factors, but not the driving factor. And if you go back to 2018 or 2019 or 2020, there's always a hint of macro, but it hasn't been the dominant theme. And I think that's where we're back to in digital assets.
Well, I mean, look, it's no different than any asset class, right? It's no different than equities, right? At the end of the day, equities are driven by macro, directionally speaking, right? We've gone through, massive, supply chain issues, and now Target, I think this morning just announced another disappointing quarter because, and this is Raul called this. He talked about it, right? Last quarter was excess inventories, and now it's about, okay, you actually have to slash the prices to actually sell that and get things out there. So, you know, yeah, Target is trading off of its fundamentals, but its fundamentals are driven by the macro environment, right? And then catalysts within that, for equities, say, will allow people to, adjust their models and under, future assumptions. What's interesting to me about digital assets now, and I would argue it's not a positive, right? But I think it's very temporary and based on the dynamics of, you know, how early we are and how nascent we are is, in equities, right? Um, Stock price is driven by the fundamentals, right? Irrespective of macro environment, because that's just up or down. But the magnitude is driven by the fundamentals. In digital assets, there's a large component now where, and I think you were getting at this, where the fundamentals are driven by the price, right? Because just the nature of who's in this market now, how thin it is, and there's a lot of reasons why that is. We see, I think if we look at the overall growth of, wallets and blockchain users, right? Like it's a very steady increase,
Mm-hmm.
but you'll see massive spikes up and massive spikes down because there is speculation, there is leverage. And as that goes up in more speculative times, price goes up and people use these chains more, they transact more, they use new products more. The fundamentals look really attractive, right? So it's compounding, but it's all price first. There are other, in blockchain, it's like it's too early to tell. Like, Axie Infinity looks great, right? But who really knows? Because
Well,
there's no such thing as a normalized environment.
there's a couple of reasons for that, right? First and foremost, other than Bitcoin, and I guess it's to some extent Ethereum. I mean, there's no digital asset companies or projects that are older than like really 4 years old in any meaningful
Sure.
capacity, right? And if you look at most 4-year-old and younger companies in the traditional debt and equity world, they don't have publicly traded tokens until they IPO many years later, right? Like let's take Robinhood for example, right? I remember when Robinhood was going higher. I think they had like they went from like $1 billion valuation to like a 7 billion valuation in like 6 months, right? Well, that was a private valuation. That just means somebody decided to give them money at $1 billion, and then 6 months later decided to give them money at like a $7 billion valuation. But in between, the volatility of that probably went from a billion to 3 billion down to 1 billion up to 6 billion down to 4 billion. Like, the inherent volatility of what a business like Robinhood at that point was worth was crazy because their user growth was changing all the time, their revenues were changing all the time, their model was pivoting. There was all these different things that were happening that you just didn't see on a day-to-day basis because there was no real-time reporting, there was no real-time financials, and there was no real-time price. In digital assets, when these tokens become public almost right away, if not right away, and you have on-chain data, which is basically like getting like a real-time 8K every minute of every day, combined with real-time prices that drive sentiment, it does impact the business in the same way that if you had a small bank that just started a regional bank and it had a public equity price, and all of a sudden the equity price fell 50%. Well, guess what? They're going to lose a lot of their customers, right? People are going to run from a bank if the stock went down 50% in the first 3 weeks of opening their
Mm.
doors. So there is
These are actually really good points.
yeah, I mean,
Yeah.
there is a component of price driving attitudes and sentiment and business because of the fact that it's public. On the other side, the other thing that I think is relevant is that a lot of the tokens have incentives in their own token, right? So one of the things we talk about, which I think is still a net positive, even though right now it's acting as a net negative, is that these are businesses and projects that are rewarding their customers and their users and their developers and their investors all with the native token, right? If whether it's yield farming or some other inflationary reward, we're basically saying if you do some sort of an action as part of a participant in our ecosystem, we're going to reward you with the token. Well, as the token price goes lower, that means the rewards are going lower. And as the rewards go lower, that means those incentives are less interesting. So you have a much bigger reflexivity both up and down when the price of the asset that you're getting back in return for using the service goes down.
Hmm.
And then third, and probably equally important, is you know a lot of these if you think of a blockchain as a nation and the currency of that blockchain being that currency, well, if you spend your entire life inside of that ecosystem, you don't really care about the price, right? If everything you do is denominated in ETH and every activity you do is in the Ethereum ecosystem, well, guess what? When Ethereum falls 50%, so do all the things that you're using within the Ethereum ecosystem. So your actual purchasing power in ETH is unaffected, right? In the same way that if you live in Greece and you never travel abroad and you never import anything from other countries and all you do is live in your own little microcosm in Greece and you own a bodega and you shop with the same four merchants next to you, you're probably not affected by the fact that the euro is killing you or before that the drachma was moving all the time because in your local currency nothing changed. It's only when you compare currencies across borders where things change, right? Another example would be imagine if you were a US investor in a Brazilian company and the Brazilian company is killing it in Brazil, but the real falls 50% versus dollars. Well, in Brazil, the company's doing fine. They're doing great. But if you're a US investor, you're getting killed because of the currency risk because it's outside of that Brazilian ecosystem. So that's the third factor is that as much as we're trying to build this blockchain world where everything is kind of native to the blockchain world, the fact of the matter is people still are having their costs in US dollars. They're still comparing it back to US dollars. So that's another reason why price really affects businesses is because they're not fully encompassed within that native currency. You still have other costs and other issues that are happening outside of that in either U.S. dollars or euros or whatever. So I think those three factors are a big deal in terms of why price really affects business fundamentals right now.
Do you think that's always the way it's going to be? I guess I'm not sold on the fact that we're not going to have a fiat global reserve currency for the foreseeable future. I mean, I guess if hypothetically, if there is a single blockchain that wins, and say it's ETH, and we look forward 20 years, and basically similar to the internet analogy you were using earlier, like blockchain is the custodian for every asset, right? Liquid, illiquid, and transfer agent for every asset, then yeah, I could see like ETH being the de facto global reserve currency, right? Because you pay your transaction fees in that asset for every transaction, so you might as well pay for the assets in that transaction. That said, like, when I look at now and I buy something using ETH, right, which isn't a lot of things, but sometimes, it's still the asset is still being sold to me on a dollar basis. So, if ETH is worth 2,000, right, versus 1,000, that asset, whatever I'm buying is half the cost, right, as when it was 1,000. Um, Now maybe with like certain NFTs or something that's not the case, but I have a I don't know that we move away from that dynamic. Certainly not anytime soon.
No, I think of the three things I mentioned there, I think number three is one that will always be there. I think you'll always have that price reflexivity because of the fact that these are, native currencies within their ecosystem, but you're pricing them in dollars or some other currency. I don't think that will ever go away. But you can see where it will slowly become less impactful. Like let's use Netflix, for example, right? Let's say Netflix, in 10 years, Netflix has a token, and that token can be used to pay your monthly fee, but also maybe having that token gives you, early access to a season finale or early access to certain movies or IP that come out, et cetera. So there's a real reason, not to mention maybe 10 or 20% of Netflix's earnings get dividended out to you if you're a token holder, right? So you create a Netflix token that looks more. In that regard, if Netflix's, token price and share price start to go down, but you're still owning and transacting everything within the Netflix ecosystem in Netflix token, chances are the prices of what you're buying are going down as well. So you're not going to be as impacted within that Netflix ecosystem. Now, if you tried to take that Netflix token and convert it into dollars or convert it into, United Airline miles or something like that, then obviously, yes, it has lower purchasing power outside of that system. So I do think you will get into a world one day where within these ecosystems, the prices themselves have less impact on the businesses. But we're just not there yet, right? We're not there yet because, again, everything that we're doing is still, not a full kind of economy, right? It's like a half economy or a quarter economy where you're doing bits and pieces. Like you said, you do some things in Ethereum, but you can't do everything. Well, if all you did was, NFTs within Ethereum, then you probably wouldn't care that the Ethereum price is down because all the NFTs that you'd be buying are down just as much, right? So your purchasing power in ETH terms hasn't changed at all. So I think it just depends on how big and impactful blockchain really gets, and whether or not you really can kind of live at least a part of your life within just an ecosystem without having to travel outside. And now it's not practical. Again, like even my Greece example, right? Greece is not, if you're a local Greek citizen, it's not like you're not impacted by things happening in the outside world, right? You're still importing from other countries, you're still
Yeah.
traveling, right? So it's not fully practical anyway. But I do think there's an interesting point there, with regard to what you said a few minutes ago about Target. You mentioned Target having a high. First, they have a massive inventory, and now you have to start marking down that inventory and selling it at lower prices. Well, I think this is one of the reasons why, again, I think the decoupling in digital assets is real, right? When we went from November of last year, 2021, to May of this year, or June of this year, when everything was just based on the inflation trade, right? Inflation is too high. Central banks are going to fight that, and the Fed is fighting even faster than other central banks in terms of how fast they're raising rates, right? That was a pure shock to the system, a pure macro trade based on the rate of change of response. Now, as the market is less focused on inflation, because you've seen all these inflation indicators going down, right? That the cure for higher prices is higher prices, right? Spending is down, gas consumption is down, inventories are down, et cetera. Or inventories are building rather. All these deflationary pressures that are happening in the market, and that's what caused the market to switch from being fearful of inflation and rates to now being more fearful of a recession. This is why I think digital assets are going to outperform much more in the second half than they did in the first half. Is that a recession, in my opinion, is not going to impact the majority of these crypto companies that we're talking about, right? They don't have inventories. There's no buildup of inventories. There's no cost of goods sales. There's no massive rents or costs, other than employee costs. And a lot of employees are, again, paid within the native token, right? If you're an employee of a Uniswap protocol or DYDX or Sushi or you name it, a lot of your compensation is coming in the native token itself. So as a result, when you start to switch from this massive inflationary pressure, which affects everything from the dollar to a stimulus to all the things that do impact flows of funds, and you switch to more of a recessionary environment, there's very few companies in the digital asset space that are going to be affected from that from a fundamental standpoint. So, to me, that puts even more credence into the fact that you could see equities retest the lows, and you could see, earnings fall off a cliff where it doesn't actually have a material effect on the digital assets or the investments in these tokens.
Um, I think that's fair in a lot of ways. I mean, the demand side of it, I don't know how much the demand side has changed as a result of inflation, because I don't think it was ever, you know, that much higher. I think it was mostly a supply issue. Now it depends what we're talking about, right? Like oil, I don't think we went from like super high demand in oil to lower oil. It's a purely a supply story. Um, with digital asset prices, and just talk about the handful of investable assets, right? At the end of the day, it's still going to be about growth of the ecosystem, right? And it's still going to be about that up and to the right chart of user growth, which I don't think that has changed. We've seen drop-offs, but the drop-offs are typically leverage unwinding, right? Things like that. You could see it in stablecoin volume, right? Look at stablecoin volume now compared to what it was, I don't know, 2019. I mean, in kind of the quote unquote crypto winter, like what was stablecoin outstanding compared to what it is now? It's got to be 10,
Yeah.
15x.
Yeah, if you look at the last time the digital asset market cap was around a trillion, which was like a little over 2.5 years ago, stable coins was about 10 to 20 billion. Now they're 180 billion. So it was, minuscule compared to what you have today.
Yeah, yeah, yeah. I mean, there is no doubt the ecosystem is growing. And just think about, the last kind of um, you know, big bull market in kind of like what 2017. I mean, that was Bitcoin driven. Other assets went up as a result, but like the narrative across the community was Bitcoin. And I know and this is going to be anecdotal, but like I think it was largely you know by a lot of traditional investors, allocators, like much more dismissed than the hyperbolic growth over the past couple of years, which is just okay. There's going to be volatility, but this technology is real, and we'll see it play out over time. And there'll be starts and stops, but the trend is
Well,
oh
well, 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 really, I mean, if you go back to 2018, right? 2018 was like the beginning of kind of this interest in blockchain and smart contract protocols, and you had the ICO wave and everything, but you really hadn't seen any success stories yet. Like maybe Bitcoin was a success story, just in the fact that it hadn't died yet and it was like starting to grow and people were using it. So you could call Bitcoin being the only real success story prior to 2018.
hmm
Post in the last 4 years, we've had four success stories, right? Bitcoin continues to be a success story, even though I think it's challenged right now from a narrative standpoint because it hasn't fulfilled anything that people said it was going to do. But Bitcoin is 100% a success, right? A $450 billion
oh,
asset that,
there's no doubt about
yeah.
it.
Now you have stablecoins, huge success, right? From zero to 180 billion of AUM in 2.5 years. DeFi from zero to 80 billion of TVL in the last 2 years. And NFTs, right? Love them or hate them. I mean, it's clear that NFTs have penetrated the masses and are real and are here to stay, right? Certain collections may or may not be, but the idea of having, ownable digital property rights is real. So you have four legit product market fit success stories in the last 2.5 years. That's different than what we had in 2018. In 2018, we were still trying to figure out if the blockchain technology worked and if there was even token types that were investable. Now you have clear sectors, clear product market fit, clear winners and losers. So from an investing standpoint, that's where it gets really interesting to me. Is like, I have no idea. Like I said, I do believe we bottomed. I don't know when the growth returns. So let's assume that I'm right for a second that we've bottomed, but we don't know when the growth returns. So what are you looking for as an investor? You're looking for four things basically, right? The first is you're looking for market leaders, right? This is not an environment where you need to buy the sixth or seventh best, DEX or the sixth or seventh best, NFT marketplace. You want to buy the number one, number two, right? It's a very short list of market leaders. But if you look at all the subsectors in the market, from the different DeFi subsectors like DEXs and borrow lend platforms and derivatives exchanges, et cetera, or you look at the different, gaming and NFT subsectors or social tokens or gaming like sports and entertainment or music. You go across the list of all these different subsectors, layer ones, layer twos, bridges. There's only one or two real market leaders. So that's the first thing you look for is I want to own a market leader, somebody who has an established presence that is likely not going to recede a ton. The second is you're looking for entities that have no chance of going bankrupt or running out of money, right? You don't want to invest in a token or project right now that has a chance of basically folding its doors because their costs are too high relative to, how fast a recovery happens. Again, in a protocol world, it's not practical, right? Even Luna didn't go bankrupt, right? The Luna protocol itself still works. So, there's not going to be a lot of bankruptcies in the protocol world, but in the application world, there could be, right? If somebody's building a gaming app and they run out of money, yeah, I mean, they could be gone. That token, is somewhat worthless. Now, there's nuance there, right? I mean, the Celsius token, for example, the Celsius token is, positive year to date, even though they filed bankruptcy, and clearly the Celsius token is going to be impaired. But for the most part, you don't want to invest in a token that has a chance of basically going away. Third is you want things that have low to no inflation, right? There's a reason that BNB is the best token ever, right? It's been an amortizer since day one. They issued all the tokens up front, and it's been amortizing ever since. Same with Leo, same with FTT. That's why Ethereum is so interesting right now, right? Ethereum is going from highly inflationary to post the merge, certainly disinflationary, if not deflationary. So you want tokens, not that inflation is a bad thing. Inflation is fine as long as the growth of the network and the business exceeds the inflation. But in an environment like this where we just don't know when that growth returns, you certainly don't want to invest in things that have high inflation because that inflation will kill you. And then fourth, and probably the most important thing in my opinion, is you want businesses or companies that have high operating leverage. And what we mean by that is, take a business that has fixed costs but variable returns. Well, if your costs are fixed and your returns are variable, well, if all of a sudden business picks up, you have massive operating leverage to the upside, right? Your revenues increase, your profits increase. The same thing is true on the token side, right? You want businesses that basically as a steady state just sort of exist and can weather the storm. But if you start to see that growth that we talked about in users and volumes and transactions, all of a sudden you have a multiplier effect on the revenues and the cash flows or the network effects that happen. So if you put those four things and you just invest in market leaders, no chance of going away, low to no inflation, and high operating leverage to the upside, it's a very short list. And you go back to what I talked about earlier, where you've got 170 billion of stable coins, you've got VCs flush with cash from all the raises they did, and you only have a couple 100 billion of these tokens outstanding. The investable universe has shrunk, and I think that's why, even though the returns have been so poor in the first half, people in the digital asset space who believe in the sector are not afraid and are not even swayed by the prospects of being able to recover those losses and then some, because you have these businesses with huge operating leverage to the upside when that user growth returns.
Hmm. Yeah, and I think that the inflationary angle is very important, and look, it's not dissimilar in concept or mechanics to a secondary offering or like looking at a fully diluted share count because of option issuance and things like that. But the difference is it's very I don't know if circular is the right word in some ways, because when the market for a specific token is going higher, and say there's like a staking component where there's rewards being paid, or you know or something along the line that increases supply, right? Then that supply increase at higher prices, kind of furthers the it builds upon itself, right? More staking, more issuance, all that sort of stuff. When that reverses, right, now all of a sudden you have a drop in fundamentals, implying a drop in the value of the token, but there's no mechanism to decrease supply, at least overtly. I'm sure each different token has its own nuance, and you can structure it probably in a way much like ETH has done, where you can burn supply, the equivalent of a share buyback or so. But yeah, it's a very it's almost like inherently the price has some sort of not only operating leverage but also downside leverage, if that makes sense.
Yeah, I think it does, and also, in a
You
roundabout
didn't
way, I
sound
think.
convinced there.
Well, I'm convinced in the sense that, again, I think it's when you think about the downside, what you're really looking for is, if you stress test your model and you stress test no user growth, no volume growth, just sort of steady state or even worse than steady state, are these businesses that can hold up, right? There are certain businesses within digital assets and beyond that can weather a storm better than others, right? And what you're looking for is, you're looking for those projects that, in a worst case scenario, at a steady state, are still able to effectively cover their costs and are able to have growth that exceeds or at least matches inflation. And then you want the flip side is if and when that growth returns, it's a rocket ship on the upside, right? It is something that just has multiplier effects with regard to that network growth, that cash flow growth, that revenue growth, if you see that return. So I think both can be true in terms of that both protecting against the downside and getting that rocket ship with the upside. But what I think is probably a derivative of that is I've been on record saying that I think the Bitcoin narrative is dead right now. This does not mean I think Bitcoin will not succeed. I think Bitcoin is and always has been a call option on some dystopian future where Bitcoin is the currency of choice because nobody trusts their governments or their banks or their local currency. I still think that is a possibility in the long run, but I don't think there's. I think a lot of the recent narrative of inflation hedge. It's certainly not defensive. Bitcoin's down just as much as Ethereum over the last, year to date, but the lagged the upside in 2020 and 2021 massively. So if you're not keeping pace on the upside, but you're also going down as much as everything on the downside, then you lose the defensive narrative. And on top of that, you've lost the uncorrelated narrative, right? So a lot of the properties that investors were looking for in Bitcoin have gone away over the last 9 to 12 months. Doesn't mean they won't come back. It just means right now that narrative is dead. But what's interesting is a lot of macro funds are now moving into Ethereum instead, right? We're hearing over and over again from our TradFi counterparts, from our OTC dealers, that the macro guys are looking at ETH. And also, some of the fundamental guys are looking at ETH. And the reason being, in my opinion, is similar to what you just talked about, which is that if you're looking for the first time ever, there's an asset that is a pure play bet on the growth of digital assets. Meaning, let's take a step back for a second. Right around the year 2000, there was about 350 million global internet users. And 10 years later, there was over 2 billion, right? So you had basically 7x in the terms of growth of internet users. And obviously, we had an explosion in companies that leveraged the internet. You're right around that same period right now in terms of digital asset users, right? This is an estimate based on wallets, and in factoring in that people have multiple wallets. But there's about 300 to 400 million, quote unquote, crypto users right now. So if you believe that, there is going to be a growth of blockchain adoption, there's going to be a growth of digital asset users, what is the most pure play way to bet on that? And historically, there hasn't been an answer, right? Because we've had, Bitcoin was a currency, and you had Ethereum as amongst other protocols being, a bet on smart contracts, and you had different sectors. But for the first time, Ethereum is probably the most pure play way to just bet on the growth of adoption of digital assets because Ethereum meets all the criteria I just mentioned. It's a market leader. 65% of all blockchain transactions happen on Ethereum. It is deflationary, or at least disinflationary, post the merge. It's not going bankrupt or going away, and it has massive operating leverage to the upside. And on top of that, Ethereum is the only thing that really touches every sector of blockchain, right? It touches DeFi, it touches NFTs, gaming, Web3, et cetera. So, I think for the first time, you have a real kind of leader in terms of what is just the generic way to express a view on the growth of blockchain. And I think that's why you're seeing, ETH back up to 0.08 versus Bitcoin. I think that's why ETH has outperformed Bitcoin so much recently. I think there's been a real kind of macro shift in terms of investors looking at Ethereum as the base asset of digital assets versus Bitcoin 3, 4 years ago. So I think that's important, right? I think that's important from a fund flow standpoint. I think it's important from a narrative standpoint. I think basically we've shifted from this narrative that everything is a cryptocurrency and Bitcoin is therefore the biggest cryptocurrency to digital assets are a technology and Ethereum is the leader in the growth of that technology. And to your
But both of those
point,
things can be the same.
what do you mean?
That Bitcoin is
Yeah,
a
yeah,
cryptocurrency and it's the biggest cryptocurrency. Because I wouldn't look at ETH as a cryptocurrency. I would look at it as a it's analogous to like the Visa or MasterCard network, except it's like if you had to pay with Visa bucks or something like that. It's
right, but
using
what?
token.
100%. I agree with you. But what I'm saying is like I think 3, 4 years ago people would get Bitcoin exposure thinking I just want exposure to blockchain and digital assets and that's the best way to get it. And I think
Sure.
now there's more and more of a consensus that Bitcoin is a very kind of niche narrative and it's not necessarily representative of all the things that are happening in the digital asset world. Whereas Ethereum, whether they're the winner 10 years from now or not, doesn't really matter. Right now, Ethereum is the best pure play way to just express a generic view on the growth of blockchain. And you hear it all the time, right? People are like, I'm bullish on blockchain, but I'm bearish on Bitcoin. It's like, okay, well, now you can do both. You can be bearish on Bitcoin, but still be bullish on blockchain via Ethereum or in a generic way. So anyway, the point in all that is not, I'm not suggesting that Ethereum for sure goes higher here. I'm just suggesting that there's a reason why the fund flows and the bids have come into Ethereum recently, right? It started with the Ethereum 2.0 merge being a reality, and it's ending with people want to place a bet on the growth of this ecosystem, but don't want to get blown up and don't want to have that downside exposure. And this is one of those tokens that right now at least has pretty good up capture and down capture for the reasons we just mentioned.
So here's one thing I think we could really see as a result of some of the stuff you're saying, and this was hinted at a little bit in my conversation with Raul as well. When I've spent time over the past years talking to larger investors, traditional institutional investors, and there's no surprise, no secret that the majority of dollar allocations have gone towards venture investments in the space, right? And a lot of those investors have differentiated and described not as private versus public markets or liquid versus illiquid, but they've described it as like, oh, I'm invested in a blockchain fund, but I'm not ready for a crypto fund or a cryptocurrency fund, right? So like basically looking at venture investments as investing in the underlying infrastructure of blockchain and digital assets, and looking at everything that's publicly traded and liquid as a more speculative cryptocurrency type investment. The shift that you're starting to see now, I think, is that um, because ETH represents an investment in the underlying ecosystem now broadly, and is differentiating itself from Bitcoin. Like, frankly, the only people who talk about Bitcoin versus ETH and argue about it now are like dopes on Twitter who, are both abrasive and just don't know what they're talking about and are just Bitcoin max. I guess if you want to call them Bitcoin maxis or whatever. But like those are the only people who still compare it, right? Because to them it's still about like, oh, this is a sound money. Who the hell cares about sound? Like, I mean, I just don't care, about that. Like, I'm not. That's not why I think this is interesting. I think it's a totally separate um, asset, and there's an odd, I don't mean to go down that path, but I think my point being that those who want blockchain exposure now have an option, and more realistically, options in the liquid token market, whereas previously it all had to be through venture.
Yeah, I agree with that. And like I said, I think you're seeing it in the flows. More credence to what we started with at the top of the hour, which was like, have we bottomed here? Yeah, I think we have. I think the fund flows are indicating you're seeing money start to come back into these other areas of digital assets. You're starting to see that dispersion, right? One or two buyers comes into a token with a smaller market cap of 500 million or below, and you're seeing this great dispersion. And then that is indicative of a market that is no longer running on macro, but is running on fund flows and fundamentals, right? I mean, if you look at a graph, take I don't know, take middle of June, right when we bottomed, and look at a graph. I mean, you'll see things that Bitcoin's up, I don't know, 15, 20% from the lows or something like that. But you've got multiple tokens that are up 50 to 150%. Things like your Lidos, your Matics, your Ape coins, your Unis, your Curves, your, DYDXs, you name it. And that's real, right? Those are all tokens and projects that have a very specific function, have a very specific niche, and you're just seeing that one or two new buyers coming in to express a view on that is having an outsized a move on the market. And that's just not what we saw for the first 6 months of the year. For the first 6 months of the year, we just saw everything moving together, based on just overall flows coming out of the market. So it's healthy. It's healthy to see this dispersion. We look at a lot of factors when we're looking at the health of the market, and that that lack of correlation within the market is really important, right? When you see about 50% of the tokens up and 50% down on a given day or on a given week or on a given month, that's much more healthy than when 90% or more of the tokens are all moving in the same direction every week or every month. So,
Absolutely, yeah. I mean, it's indicative of a real ecosystem as opposed
mhm.
to a singular trade. Last question I want to ask you, and it goes back to Bitcoin a little bit. You mentioned like, it's still a great call option on this dystopian, future where it's, there's no, faith in sovereign currency and everything is Bitcoin based. Like, I mean, and you saying that's the way Bitcoin works. I find that um, very bearish on Bitcoin because I think the odds of that occurring are obviously as close to zero as you can possibly get. But that doesn't mean Bitcoin can't be a currency, and it can't be a form of digital gold. I mean, the gold narrative, when people say, well, it's down in an inflationary environment, I'm like, well, so is gold, so it could be digital gold, right? Like, do you think that's the only way Bitcoin works? Is if it's truly like a widely adopted global, like it basically has to be the global reserve currency or bust?
Well, no, I don't think it has to be the global reserve currency. I think it has to actually be a part of that, though, in terms of what you're saying. So you said the probability of that is very low, almost zero. If you look at Bitcoin's market cap relative to the market cap of gold or relative to the market cap of global money, it's basically pricing in almost a 0% chance of it being true, right? I mean, Bitcoin at $400 billion market cap compared to gold at 11 trillion, and the entire M1 and M2 money supply in the hundreds of trillions, like it is priced as basically a zero option, right? This is a huge long-tailed option on Bitcoin being a multiple tens of $1 trillion asset one day. So yeah, I mean, I do think that that's probably the best use case of Bitcoin is this sort of global store of value or this global form of collateral or this global form of currency, which has a low probability of success, but incredibly high upside if it's right. And I look at Bitcoin the way I look at any option using a Black-Scholes framework is, you have what's the time, the timing of an option matters. Well, in this case, it's a perpetual timing, right? Bitcoin's not going away, so it doesn't matter if it takes 1 year or 10 years or 50 years for this to play out. You have that time on your side. It's not going to decay. Two is interest rates, right? Interest rates are low, which makes even though interest rates are rising, right? Real rates are still negative, and absolute nominal interest rates are still low. That's gives value to an option. And you have volatility. Obviously, volatility is incredibly high of the underlying. All these factors play into why Bitcoin is an attractive call option. So I think, in my opinion, it is priced near zero, right? If you believe that Bitcoin should be, a $20 trillion asset and be priced at $1 million per coin, well, it's a pretty cheap call option at 20,000 or 24,000 right now. If I'm wrong and there's other use cases that develop for Bitcoin, I know there's a lot of people in the Bitcoin community who believe that, there will eventually be DeFi on Bitcoin and other things that, if that's true, then that's gravy. That's even more reason for the price to go higher. But until that
Mhm.
happens and Bitcoin is just a pet rock that does nothing and it's just used as a store of value and a form of collateral, then you're going to price it like a long tail call option. And I think that's, accurately reflected in the price right now.
You should send that quote to some of your boys on Twitter.
So anyway,
Perfect. Well,
I
yeah, go
think
ahead.
no, I just I mean I think we always go back to Bitcoin, which speaks to the brand and narrative that Bitcoin has, right? I mean it's it hasn't really done anything in over a year, and yet we're still talking about it. And I think that's that speaks to what Bitcoin is, right? Bitcoin is a powerful form of money. It's a powerful it's the first ever use case of blockchain. It has a place in society and in a place in investing as a result of just that alone. But I do think the story again is that right now the story in digital assets is not Bitcoin. It's Ethereum. It's the merge. It's all the different things that are happening outside of the ecosystem. And it's nice to see macro not driving the bus in terms of price as well as news flow in digital assets.
Yeah. And look, there'll be a lot more to talk about on ETH as we progress throughout the rest of the year. And yeah, I mean, I think we're all kind of on the same page here, and certainly long term bullish, right? And you said this before. Raul said it. I've said it. Like, you're not gonna care if you buy ETH at 1,800 or 2,000 or 1,200, or if you happen to buy some at 900, right? In 10 years, you're just not going to care, right? Because it's going to be, it's either worthless or it's worth, many, many, many multiples of that. So, yeah, that was great. It's great, having you on again, Jeff, kicking off season two, and we'll do this again in a couple of weeks. So thanks for joining.
Great. Thanks, Peter.
All right, thank you, everybody. Take care.